Let's record a cash sale of some merchandise in a special journal. First, we'll look at it in the regular general journal format. So 16 Blueberry phones, 16 at $600 a piece. That is going to be the amount of my revenue. The sales tax is going to be 5% of that, or $480. And so the amount of cash I'm going to receive, the amount of cash I'm going to receive is the sum of those. I'm going to have to receive $10,800 in order to give him these Blueberry phones. He has to pay me the amount for the phones. That's my revenue, $9,600. He also has to pay me the sales tax because I've got to pay that to the state. So that's what my entry is going to look like. A debit to cash for $10,080. Have it right, $10,080. Sales revenue is a credit of $9,600, and sales tax payable a credit of $9,600. Of course, cash is an asset increased by debits. Revenues have credit balances increased by credits. Payables, liabilities, have credit balances increased by credits. Now whenever we sell inventory, we also have to make an entry to cost of goods sold. We're going to debit cost of goods sold and credit the merchandise inventory account. Inventory is an asset. It decreased by credits. We're selling inventory, so we're getting rid of it. And this is an expense, and expense accounts always get debits. So let me show you what we would do, how we would find out what this is. If we sold 16 Blueberry phones, what would it cost us? So we go to the inventory cards, and we find the Blueberry phones, and they cost us $300 a piece. That's what we have invested in those Blueberry phones. So 16 Blueberry phones would cost us $4,800. That's going to be my cost of goods sold. Those are the two entries I would make: a debit to cash, a credit to sales revenue, and a credit to sales tax payable. We would also make an entry debiting cost of goods sold and crediting merchandise inventory. But in the special journals, we're going to make these same entries. We're going to make these same debits and credits. We're just going to do them in a different format. That's all we're going to do. So let's go to the cash receipts journal. And this is June the 6th. The account is going to be revenue. That's what we're going to put down here. 400. Revenues always start with a 4. The posting reference is going to be X because we're not posting anything to the general ledger. Cash is going to be a debit of $10,080. And if you want to see that, we can go back over here and look. $10,080, a debit to cash. Sales revenue is a credit of $9,600, and this is a credit of $4,800. You can see a debit to cash, credit to sales revenue, and sales tax payable. And that's what we've got right there. We're also going to make a debit to cost of goods sold. We're also going to make a debit to cost of goods sold for $4,800 and a credit to inventory for that amount too. This is my debit to cost of goods sold and a credit to merchandise inventory. This column does both. Now we don't have to post anything. We don't have to post cash. We don't have to post sales revenue. We don't have to post sales tax payable. We don't have to post cost of goods sold. We don't have to post to the general ledger for inventory, but we do have to post to the inventory card. So we're going to go to the Blueberry phones, and we're going to say on the 6th of June, we sold, and this unit cost of goods sold is in this area, the 3 columns in the middle. We're going to sell 16 Blueberry phones, and we actually cost. We don't worry about what we paid, what we sold them for. We're only worried about our cost. Right here, that's what these phones cost us. So $300 each, or $4,800. Now let's see how many we got in stock. We had 63 on the shelf, but we sold 16. So now we have 47 left. They cost us $300. A total of $14,100. And we can check that. $18,900 minus the cost of goods sold. This is our balance in inventory before, minus what we sold, should give us the same number, $14,100. That's it. So we have entered this in the cash receipts journal: debit to cash, credit to sales revenue, credit to sales tax payable. We've entered the cost entry as a debit to cost of goods sold, a credit to merchandise inventory, and we have posted it to the inventory card. So we have the cost of goods sold and the new balance in the inventory card. When we, at the end of the month, we will post this whole column. We'll total it up and get a number down here and post this whole column to cash. This whole column will get posted to revenue, sales revenue. This whole column will get posted to sales tax payable. This column will get posted to the general ledger account for accounts receivable, the 110 account, the control account. We will already have posted all the individual postings to the subsidiary ledger. Anything in the other account will post immediately to the general ledger when we post it. Cost of goods sold will post at the end of the month, and inventory will post at the end of the month to the general ledger, because we've already posted the inventory cards every time we made an entry. And that's it.